Hello and welcome to The Print. I'm TCA Sharad Raghavan, and today I'm going to be talking to you about defense stocks in India and how they've gone from boom to bust. That is, from consistently rising over the last 4 years, almost all of them have been falling quite sharply over the last 4 months. The narrative driven surge in the stock prices of defense companies has now petered out, with several of these stocks falling 30 to 40% in just a few months. Analysts say that the sharp rise in these stocks post the COVID-19 pandemic was driven by newbie investors looking to jump on the bandwagon of a booming stock market. And these investors were then led to invest in these stocks by social media influencers. These investors are now facing the reality of project delays and low profitability amongst defense companies. Data from the Bombay Stock Exchange shows the 9 defense stocks that the print has analyzed grew an average of 606% between January 2020 and April 2024, with some outliers being Hindustan Aeronautics, which rose 881%, and Mazagon Dock Shipbuilders, which rose a whopping 1308% over this period. A large part of this rally in defense stocks was driven by a perception and narrative that the Indian government's decision to increasingly source its defense procurement from the domestic industry would result in immediate gains for these companies. This narrative-led stock market enthusiasm has been reported on before by the print in a multi-indicator analysis that pointed to a bubble forming in India's stock market. At play, according to stock market analysts, was a surge in the number of new and inexperienced investors entering the market since the COVID-19 pandemic, their relative gullibility in the face of investment advice from social media influencers, and a fear of missing out or FOMO on the ongoing stock market boom. However, what this meant was that these new and often young investors ignored sector-specific factors that impact the profitability of defense companies, such as the distinct possibility of cost and time overruns on projects, and the dependence of these companies on a single buyer, which is the government. As project delays became apparent and new orders to defense firms started flagging, investors began to lose interest, a trend that has led to the sharp fall in the stock prices of several defense companies over the last few months. Of the defense-related stocks, the shipbuilders have faced the brunt of this changing investor sentiment. Kochi-based shipbuilding and repair company Cochin Shipyard saw the biggest fall over the last few months, falling more than 40% from its peak in just July this year. Kolkata-based shipbuilding firm Garden Reach Shipbuilders and Engineers saw its stock price fall 30% since then. Other defense stocks that saw big falls were Bharat Dynamics, Mazagon Dock Shipbuilders, and BEML. The print spoke to a few stock market analysts to fully understand what's going on. VK Vijay Kumar, Chief Investment Strategist at Geojit Financial Services, explained that in shipping especially, there are execution challenges. Shipbuilding is very capital intensive and it takes months and sometimes years for an order to be executed. And there can be cost and time overruns on top of this. But Vijay Kumar added that a lot of the new investors who entered the market post 2020 were ignoring all of these challenges and were just buying these stocks because there was news that the company had received an order or because some influencer told them to buy this stock. Kunal Shah, who's a senior research analyst at Carnelian Asset Management and Advisors, reiterated this, saying that in defense, because of the narrative that had been created, there were a lot of expectations built in way ahead of what could actually happen in the form of numbers and order books. The analysts also pointed out that investors ignored the basic structure of the defense sector, which leads to low profitability. As Vijay Kumar explained, the defense sector is a monopsony, which is where there is a single buyer. In this case, that's the government. And the government is not likely to buy at premium prices, so the profit margins of defense companies are slim. But the new investors don't look at all of that, he explained. ICICI Securities, in a note released earlier this month, also pointed to the underperformance of defense stocks and linked this to delays in orders. It said that defense stocks have not fared well over the last few months, mainly due to a relative shortage of fresh orders and delays in expected orders, adding that new orders have fallen short of expectations. That is now being sensed by the markets. Shah of Carnelian Asset Management explained this in terms of the FOMO phenomenon, a factor driving people to buy stocks and which now seems to be ebbing. He explained that what happens is that a narrative gets built that some stocks will go up, and then lots of people flock to buy that stock, and newer investors jump on the bandwagon because they experience FOMO. But this FOMO effect also starts fading away, as is happening now. Another factor that could be playing out is the manipulation of stock prices in those companies that have low levels of floating stock. Floating stock is basically the amount of stock that are open to the public to buy and sell, the rest being held by the promoter. Vijay Kumar explained that when there is low floating stock and most of the stock is owned by the promoter, it is possible for a cartel of operators to buy excessively from the few stocks that are available. In such cases, there won't be commensurate selling because the bulk of the holdings are held by the promoter, which in public sector companies is the government. So, this buying during low supply pushes the stock price up. These market manipulators can then choose to sell when the price is high, flooding the market with their holdings, resulting in profits for them, but also a sharp fall in the stock price. All of this said and done, Shah added that this doesn't take away from the structural long-term story in defense, which is something he's still very convinced about. But, he said, investors must be wary of overvaluations, which are now getting rationalized and which have further scope for rationalization as well. But on that note, that's all from me. Thank you for watching.